Okay, so I promised you, I promised you that we would raise financial cattle yesterday. Okay, so we would calculate the cattle spread. So that's the relationship between three types of contracts actually. Two input contracts and one output contracts. Okay, so let me pull up the slides. Okay. Now you should see that. No, it doesn't work. Something's wrong. Okay, let's try again. Okay, so I just share my entire screen. Now it works. Okay, so we were talking about these trading strategies. Okay, how can you make money in financial markets, in commodity markets? This is not the slide I need. And we were first talking about spread strategies. Okay, so you have two types of spreads. You have intra and inter commodity spreads. Okay, or intra commodity spreads are also called calendar spreads. Okay, and with these kind of spread strategies, you can place a bet on a changing of the slope without being exposed to the overall change in the prices. Okay, so you are hedged because you have one short and one long contract, but you will make money if the slope, but depending on what kind of spread you're making, if the money, if the slope goes up or slope goes down. Okay, and of course you're also to a certain extent exposed to the price change. That's why you have the bull spread and the bear spread, because typically when the prices go up and down, the slope changes as well, but the way the slope changes with the price level depends on the commodity. Okay, anyhow, so we'll see this in a minute, but let's now look at this, the financial cattle. Okay, we are going to raise cattle. We are going to replicate what these guys are doing. Okay, so these guys are raising cattle in the desert, as you can see. So I think they're just fattening these. Okay, so they buy so-called feeder cattle, and then they buy food. Okay, soy and corn, and then they sell the cattle when they have reached a weight that is appropriate for slaughtering. Okay, so here you have the time frame and you have the different contracts. Okay, so the calf, once it's born, it stays with his mother or with the farmer for a year. Okay, and then it is sold off to a fattener. Okay, somebody who's gonna just bring it to slaughter weight. And so that's taking another 6 months. Okay, and we are interested in that period, the period between the first anniversary of the calf and the time when it's being transformed into a steak. I'm sorry, it's not very it's not very nice, but okay, so we have a 6 months period. Okay, now what happens? Okay, so obviously these prices need to be somehow correlated. So if the feeder calf become more expensive, we would expect that at least 6 months later, the live cattle become also more expensive. Okay, but the difference between the feeder and the live cattle also depends, of course, on the price of the food that you have to give to these animals so that they reach the slaughtering age. Okay, and that's what we exploit in this cattle crush bet. Okay, we exploit the fact that a certain number of feeder cattle plus a certain number of soy or corn, okay, should have the same value or should be related to the value of the live cattle. So the input should be related to the output price. Again, with the argument that if there's a too high difference, okay, so if the feeder cattle are very cheap and corn is very cheap, then everybody will jump in. The farmers will start raising more live cattle, and that should increase the price of the feeder cattle and potentially also corn. But the corn market is really very large and probably not influenced by only the cattle ranchers. So you would have the feeder cattle go up and the live cattle go down because there will be more live cattle arriving in the market. Okay, so what's the precise situation? Okay, so what will happen actually if you are a guy, if you're this guy, okay, or if you are, so in this case, I take the position of the owner of a newborn calf, okay, he wants to make sure that he can reimburse his loan, okay, so he needs to hedge his profit. So he can do two things. He can either buy a contract, sell his calf with a contract on feeder cattle in 1 year, or he can sell his calf as live cattle in 18 months. Okay, but if he sells it as live cattle, he should also hedge the cost of feeding the cattle. So he should also have a long position in corn futures, okay, to make sure that he doesn't have to pay too much for corn. And I'm pretty sure that for example, at the moment, I mean, you have seen the massive increase in the wheat and corn prices. All these grains have massively increased. If you are a farmer at the moment and you haven't hedged against the increase in these food prices, you will have trouble. You will have trouble because, and we will see it. Okay. So what is the cattle crush? So for the cattle crush, so again, it's the relationship between the input and the output. Input is corn futures. We simplify. Again, these cattle are normally fed with not only corn, they get soy, and they probably get even some hay, okay, probably vitamins and stuff, okay. So but we simplify, we assume that's only corn. So corn and feeder cattle are the input and live cattle are the output. Now again, similar to the case of the soybean crash, remember, where we had input soybeans, output soy meal, soy oil. The interesting question is how many contracts of one produce how many contracts of the output? Okay, how many contracts of the input correspond to how many contracts of the output? So here's the information that we need for that. Okay, so a feeder cattle, so that's the small ones, they weigh 750 pounds. Okay, and an average live cattle weighs 1,200 pounds. Okay, so they almost double in size. Okay, so that's why they have to eat a lot. And now a contract of feeder cattle, if you remember, okay, is for cattle with a weight of 50,000 pounds. Okay, let's just pull up the contract here. Feeder cattle. Okay, security description. Okay, contract size 50,000 pounds. Okay, price is given in pence per pound. Okay, so 1 pound, one increase in price is one increase. So if you go from 167 to 168, the contract value increases by $500. Okay, okay, and that's what we need to know. This is the May contract. The the value of the underlying cattle, 50,000 cattle, that 50,000 pounds of cattle, okay, traded at 167 pence. It's $80,000. Quite expensive, actually. Gone up quite a bit since I've looked into that last time. Well, yeah, not recently, over the last year. Okay, feeder cattle have remained quite stable. So let's also look at the live cattle. Security description, let's start by that. So live cattle is 40,000 pounds. It's a smaller contract, strangely. Okay, well, you will see why in a minute. and the prices again in pence per pound. Here, US dollar per pound. It's not dollars, it's pence actually. And the current price is 140. Okay, we can look also at the the price evolution. Yeah, I mean, this one has been going up quite a bit. Okay, so it's interesting that the so this is a 5-year graph and this is the 1-year graph. So let's put the 5-year graph as well. Okay, so live cattle have gone up quite a bit. Feeder cattle not so much. Interesting, huh? So why is that? Again, we have to look at the corn contract. Corn, okay? Which is one of the most important foodstuffs. Here's the contract in bushels as usual. Okay, these stupid bushels. What's happened to corn? Here we go. Okay, if you look at the corn contracts, the corn prices have gone up quite a bit. Okay, and presumably, okay, the increase in these cattle, okay, the ones that have already eaten a lot of corn, is compared to the increase in the value of these cattle, is related to the increase in corn prices. Okay, let's look at the soy contract as well. Okay, because that's another big food component. And I'm pretty sure that this one has increased as well. Yeah, same pattern. Same pattern. It's exactly the same pattern as the corn. So this is the 1 year, not the 5-year. But let's look at the 5-year. Very, very similar evolution. Actually, I could try to overlay these two graphs. Let me check the chart. This is the soybeans. Okay. Okay, but this is only the. That doesn't work. Okay, anyhow, let's not waste time on this, but you got the idea. Okay, so we have the input price hasn't changed all that much. The output price has changed a lot, and the food has changed a lot in value. Okay, increased a lot in value. Actually, it looks more like the soy rather than the corn. And I think actually that these animals are mostly eating soy. Anyhow, okay, so let's go back to the can you see all that? Just check that you can all see. Yes. Let's go back to the cattle crush. Okay, so 750 pounds for feeder cattle. Live cattle is 120 pounds, 1,200 pounds, sorry. And then we have these contracts that strangely have a different size, 50,000 and 40,000. Okay, and now we need to know how much corn we need for bringing one feeder cattle to the state of a live cattle. Okay, and the information we have here is that a cattle needs 2 tons of corn to transform in 6 months from a feeder cattle into a live cattle. Okay. Okay, and then the remaining information we need is how many tons are one contract of corn, because unfortunately, as you know, it's given in bushels. Okay, but we know that 5,000 bushel is 127 metric ton. You have to be careful because you have the British imperial tons that are somehow different from the metric tons. So roughly the same, but not exactly. Very confusing. Okay, but that's not the question. Okay, so here we have the input data. Now let's figure out how many cows we have in one contract of feeder cattle and how many cows we have in one contract of live cattle. Okay, once we have this, we know that we need 2 tons of corn per cow, and that can give us the relationships we're looking for. Okay, so pretty simple. Okay, we've said a feeder cattle weighs about 750 pounds, and one contract is for 50,000 pounds, so it's on average 66 cows. Okay, depending on the size, but roughly 66 cows. Okay, now a live cattle has a weight of 1.2 tons. Okay, no, this is pounds, sorry, it's something like 600 kilo. Okay, so it's 1,200 pounds, and the contract is for 40,000 pounds, so that represents 33 cows. Okay, and now we understand why actually these contracts have a different size. Okay, because actually one contract of live cattle is exactly half a contract of feeder cattle. Okay, that's why one is on 50,000 pounds and the other one is on 40,000 pounds. Okay, so if we buy one contract of feeder cattle, we will have 66 cows. Okay, and then we need 2 tons for every cow, and that's also quite convenient because 2 tons per cow, that is 133 tons. Okay, it's almost exactly one contract. Okay, remember, a contract is 127 tons. Okay, some of the cows will be a little hungry here. Okay, but these are very approximate numbers anyhow. Okay, and maybe they eat something else. Maybe there's some grass also for them to eat. Poor animals. Okay, so one contract of feeder cattle and one contract of corn will turn into 2 contracts of live cattle 6 months later. Okay, so now we have the relationships between input and output. Okay, and now we can raise our financial cattle. We can figure out whether this cattle spread is high or not. Okay, the cattle crush or cattle spread. we can calculate whether it is profitable or not to raise the cows. I mean, of course, there are other costs. I mean, you need land, you need wages, you need energy. Okay, so we need to factor that in that as well. But I mean, that's not something we can do. But we can figure out if we have an idea of how profitable this should be, and if we see that this cattle crush or cattle spread is very high, but we can place a bet on these prices realigning. Okay. Okay, so let's do that. Okay, I mean, this is the data from last year, but let's check our current data, and let's just enter these data into Excel to figure out whether the farmers are making a lot of money in the US. Okay, so here we go. Okay, so we said we need an input of feeder cattle. Okay, so let's go to our price price chart, price table. Okay, so let's suppose that's spot price. Let's suppose okay, why not for a spot price? Okay, let's do it with the spot price for the moment. And then but I think we don't have let me see, do we have a spot price for corn? We may not have a spot price for corn. Okay, we just have the May contract. Okay, okay, let's do it with the May contract. Okay, so we have the May 22 contract here in we are back to the feeder cattle. Okay, so let's suppose we we buy our young calves in May. Okay, so let me see. Okay, we buy the cattle. So which one of the contracts is relevant? we have a big bid and an ask. Okay, it's simple. If you want to buy, it's always the one that's bad for you. Okay, so if it's buy, it's the ask contract. Okay, so we have 158, 158.6. Maybe we should put that here. Okay, so that's okay. Feeder for delivery in May. Okay, that's our first input. Then we have our second input, which is the corn. And again, we buy the corn in May. And again, we buy it at the ask price, but you can see that actually bid and ask is very close here. Huh? These are very, very large markets. Look at the open interest. I mean, the open interest is half a million. The open interest in the cattle market, it's just 2,700. Okay. But it's quite high here, because that's interesting. Huh? So the August contract is quite high. So people have started to offset here. You can see that. So there were a lot of contracts in May, presumably. Sorry. Oh, what I did is I used the wrong contract, guys. I should have pointed this out. Somebody said this. No, nobody pointed it out. Why did I use the wrong contract? Because actually I used the first contract and I thought it was May, but it reads March. Okay. I'm not sure you can see this very well. So actually it's not the right contract, but it doesn't really increase the font size, does it? Okay, that's the one we need. Okay, actually we need the one with a lot of open interest, 50,000 contracts outstanding here. Okay, and actually the March contract, not surprisingly, has already been largely offset. We are already in March. So for these contracts, you probably have to deliver. Okay, now May contract, we said May contract, it's 168. Okay, so the curve is upward sloping quite a bit. We can see it here. It's really in a lot of contango. Remember, 168 is the relevant price. 168, not 58. Let's be precise. Okay. 5, but frankly, calculations are not. Okay, now we have corn May. That's what we need. Corn in May is quoted at. May is the first contract here. We have only one price because the bid-ask spread is very, very small. It's a couple of, I mean, it's half a cent or something. So it's 742. Okay. Okay, and then we have to calculate. We have to find the live cattle contract. So yes, live cattle contract, which is here, and we need this contract for 6 months later. Okay, so we need it in September. Okay. Oh, 6 months. Okay, we need it. Which one do we have? Okay, the October contract would be the relevant one. Okay, December is either the October or the December contract. The prices are actually quite a bit different. So if it's October, it's May to October. That's only 5 months, and if it's December, it is 7 months. So, but let's take the October one. Okay, 144.5. That's the ask. Okay, yes. Again, you can see that the very short contract is already partially offset because the open interest is declining. Okay, so we said October 144.5. Okay, 144. Okay, live October. Okay, so these are our these are our numbers, but now we have to calculate the values, of course. Okay, and for that we have to multiply with all of these different units. Okay, so the feeder contract was in pence per pound. Okay, so we have these number of pence. So first of all, we should transform it into dollars, okay, just to not be too confused, okay. And then we had said it's for 50,000 pounds, okay, and we should get 84,000. That's the number we also saw on the, that's the number we saw, okay. Feeder May, they don't give us the they give us the if you go to security description, we get the contract value, but we get it for the 83,000. Okay, we get it for the nearby, the first contract that expires. Okay, so buying our feeder cattle would cost us 84,000. Okay, now the corn, we said we need one corn contract. Okay, so that's fine. So let me remember. Okay, so what's the corn contract? It's in pence per pound. Okay, so it is no, pence per bushel. Okay, so let's again divide by 100 to be sure that we have dollars. Okay, then we have the 5,000 bushels. Okay, and the 5,000 bushels correspond to the 127 tons. Okay, so that's actually the money we need. Okay, it indicates euros here. Yeah, it's never mind. Okay, so we don't have to multiply with the tons because we know that one contract is exactly what we need to feed these cows. So we need directly the contract value. Let's again check that this corresponds to what they have here. 37. Okay, so here we have it. Contract value is 37,000. And now we're selling the cows again. Okay, so actually we have to pay that, okay, to raise the cows, and now we're selling them. Now we're selling them for 144. First of all, yeah, okay. We're selling them for 144 pence per pound. So again, divide by 100 to get the dollars. Okay. Now we have what? We have a contract that has a value of 40,000 pounds. Okay. And we have two of these contracts. Okay. Would be strange if yes, here we go. Okay. This is the input and this is the output. Okay, so the cattle crush is what? It's the difference between the output and the input. Okay, so it is this minus that and minus that. Okay, so how much is this? This is minus $5,000. Okay, so why is that? Probably because some of the so that would correspond to the profit you can make from a financial cow. Okay, why is it negative? It shouldn't. I mean, it shouldn't be negative, but it's negative probably because these cows don't eat only corn that is bought on the futures markets. Okay, so these cows probably also eat some grass, okay, and some hay or some other commodity. So we have probably overestimated the price of the input food. But you can see that, okay, there should be a relationship between these three variables. Okay, we could substitute corn with soy, or we could probably balance it out more precisely to know, I mean, what's the proportion of what kind of food. So you can see how we could refine our calculations. But essentially, if that's if you have some experience of how much this value should be, then we can try to speculate on the relationship between these three variables. Okay, and actually when I calculated this last year, it was negative as well. So the cattle crush like this seems to be normally negative. And again, I guess the idea is that they have some cheaper food for these cattle. So that's so that's why you get a negative number. Okay, but then when the cattle prices go up and down, or when all of these prices go up and down, this relationship here should be more or less constant. I mean, we can check it. Okay, so what we can do now is, okay, let's do a second thing. Let's calculate this same cattle crash for a later date. Okay, so no, that's not the thing I need. So let's calculate it for a farmer who starts to raise his cattle, let's say in, see what we have here, because these contracts don't have a much, I mean, they don't get out far out here. So feeder cattle, the last contract is the January 23 cattle, and the live contract is, the last one is August 23. But that's perfect. Okay, so actually we can check what would be the cattle crush between January and August. Okay, so that is exactly a 7 month, yes, depending, a 6 months period. Okay, so let's do that. Okay, so this was for May. This for May. May 20. Okay, no, I should probably do. Okay, this was for 22. Okay, let's do it for 23. Okay. So for 23, if we pick up again these prices, feeder corn, feeder 23 186. Okay, 186. Strong contango. Oh, we can see that. Corn May. No, sorry, corn. January 23, I said. Okay, so January 23. So we don't have a January contract, so we use the December contract. Okay, so we buy this corn a little earlier, 178.5. Okay, 178. There's a problem. There's a problem. What is going on here? 74. 578. This is too small for me. 578.5. Okay. And then we have the live contract. We said we use the last one as we don't have an ask here. It really, well, let's talk the bid then. 145. Huh? Only 35 contracts being transacted here. 140. The bid ask spread is not so high. 145. Interesting, huh? I mean, you can see a lot of things here. So now, normally, if we pull over this formula, we should get the 23 prices, the 23 cattle spread. Come on. Yes. And here we do the same thing. Almost exactly the same number. Okay. Minus 5.9. Okay. Despite the fact that the prices have changed quite a bit, in particular the feeder. So you can see that actually the input feeder has the futures is higher. Okay. But the futures for the corn prices is lower. Okay. So but the overall relationship is more or less the same, and this cattle crush has about the same negative shape. Okay. So that's 2022. 2023. Okay. Now let's make an assumption. I'm not a specialist in cattle futures. Hillary Clinton is, remember, she made a lot of money from that kind of speculation. Let's make an assumption. Let's assume that the cattle crash, we think that it is too high for 2023. okay, too high. No, let's say too low, okay, too low. The negative number is too high, okay, too low, okay, assumption. Okay, we think that this is not enough profit. Okay, we've seen that if you do the transaction now, the cattle spread is smaller. Okay, so we think that this number should increase. Okay, it should become smaller in absolute terms. It should increase. Okay, now if we don't know how, okay, we don't know which one of these individual values is going to adjust, but we know that this is a too low profit. Okay, so if we subtract the fact that these farmers, okay, feed these cows something else, but we think that's too negative. Okay, farmers cannot be working profitably at this kind of negative cattle crush rates. Okay, so something must happen. Okay, either the corn prices adjust, or the feeder cattle adjust, or the live cattle adjust. Something must happen. Now, the question is, how do we benefit from this knowledge? Okay, again, the idea is we have no clue where the overall prices are going. Okay, we have no clue if the corn price is going up or down, or the feeder up and down, or live. Okay, so individually we don't know, but we have the impression that this relationship is not where it's supposed to be. Okay, so what can we do? If we speculate, so we speculate on okay, speculation, okay, cattle crush will increase, okay, decrease in absolute values. Okay, so how shall we profit from that? Again, we have to place a bet, okay, on these contracts with the correct proportions. Okay, so two contracts. Okay, maybe I should number contract. We have one contract here, one contract here, and we have two contracts of output. Okay. Now, okay, so we think that the number is too negative. Okay, which means that either the live cattle, okay, are too cheap, or that stuff, the input is too expensive. Okay, so we would think that this is going up and this is going down. Okay, so what we need is we need short position here, a short position here, and a long 2 times long, okay, position here. Okay, that's the kind of cattle crush we would need. Okay, we can take this now, okay, using these January, let's maybe add the date. So this is live October. No, this is live 6 months later. Okay, 6 months later. Okay, so this was for starting in May. Okay, this was a contract starting in May 22, and this was the contract that started in January 23. Okay, so the cattle spread. Well, happens here. Okay, anyhow, that's not. Okay, so what we will do is we will short the January 23 feeder contract. We will short the January 23 corn contract, and we have a long position in two of the what was it, August 23 live cattle contracts. Okay, that's what we have, and then we just sit on these contracts and we wait and see. Okay, remember again that we don't have to invest any money there. We just deposit the margin. Okay, we deposit the margin that corresponds to that. The margin will be relatively low because as these prices move together, this is going to be taken into account by the clearinghouse, and they will allow us to not, just use the margin, which is a sum of the margin that we would have to invest if we have an outright position in every one of these futures. So we invest a relatively small margin, and we wait and see. Okay, and if things work out as we expect, okay, indeed, the farmers will find that it is not profitable enough to raise cattle, okay, and they will therefore, okay, stop buying feeder cattle and stop buying corn, and that should drive down these prices, okay. And there will be fewer live cattle arriving on the market, and therefore McDonald's, they have to pay higher price for their live cattle, so live cattle prices will increase. So if indeed the farmers react as we think they should, because the profit is not high enough here, then maybe in October or November this year, okay, the prices will have adjusted. And when the prices have adjusted, then we just offset our contracts and we lock in our profit. Okay, that's the idea. Okay, so that's the cattle crush, and it does exist. So people actually, you can even trade it as a portfolio. The Chicago Board of Trade, they propose you don't need to compose this yourself. You can buy, okay, immediately buy the cattle crush. So you buy this combination of contracts. So it's a fun way of illustrating how you can exploit these industrial relationships between input and output material in generating profitable trading strategies. It's not a massive contract, but still, I mean, this beef production is a huge thing in the US, and it's largely industrialized. Okay, it's not small farmers raising the cows on their own farm. And as we see, I mean, the number of contracts that's being traded is not negligible. So again, we can, I mean, if you see here, June contract, this is what 126,000 contracts of, this was the live cattle, okay, live cattle. So if we have 160,000, okay, how many contracts did we had here? 126 to, okay, 126, let's round, okay, that's the number of contracts. Each contract has a value of, let's take this number. Each contract has a value of, I think it was 56. It's the live cattle. They have a smaller 56,000. Okay. 56,000. Okay. So that's again 7 billion. Okay. In contract value. Pretty impressive. Okay. So I thought it was a smaller market, but actually it's not. It's a massive market. Okay. The market has a 7 billion volume only on 1 month. Okay. That's just for 1 month. And you can see the number of, okay, so there's a lot of money involved apparently. And that means that these relationships, I mean, there's lots of people that think very careful about these relationships, okay, and all kinds of potential problems that, I mean, this, you can spend your life obviously on figuring out, okay, what should exactly be the cattle crush, depending on all kinds of parameters that you need to know. I mean, the competitiveness of the industry is important, okay, of the input and the output industry. You may have, I don't know, cyclical, okay, or seasonal problems. I mean, we can see that, we have seen that these cow prices are all cyclical, and we know that cows are difficult to store, and that means, of course, that no, it doesn't come. The curve here, no, it doesn't. Oh, that's the curve already. Okay, but that's good. Okay, so this is the curve. So if we look again at the past curves here, we can see that it's actually pretty cyclical business. Okay, so the May contracts, this is the April contract. The April contracts are always much more expensive than the remaining contracts. Interesting, in 2017 the prices were much lower as usual, because but because the corn and the wheat and all these grains were much cheaper, so we have a general food inflation since then, and the curve was in backwardation, clearly in backwardation, which means that there was some kind of shortage here in cattle. Okay, so yes, so I mean, this is just the principle. You can see how you can refine the analysis to figure out more precisely what should be done and what is the trading position that will help us make money if if the farmers are supposed to react to these price signals. Okay, but all of that is actually in the end it's quite useful, because by implementing these trades, the speculators who work very hard understanding these markets and understanding whether there will be shortages or not, the speculators will make these prices move, and again, as these prices move, the farmers will react, and again that means that the farmers will make very smart decisions, okay, anticipating future shortages, without having to think very much about the market, potential shortages, I don't know what. Okay, so that can be left to the speculators, and then the speculators signal their information through the price. You got this. Okay, so that's the cattle crush. Okay, so you now know how to raise a financial cow. Shall we do a VWCLAP? Okay, I'm really torturing you with these VWCLAPs, but again, it's an easy way of having a grade, and let me see. Okay, and it it's an easy way for me to verify if somebody is on the other end here. So VWCLAP 6, so actually I dropped one, so I didn't torture you until the end. So let me see. So again, apparently the 6 at the end is, yes, I'm doing this. But okay, so I think that's the one. So my link has a 0 at the end because I'm the administrator, but that should work. Okay, so where is it? Here. Okay, so it's about okay, apparently you're already linked in. You're very fast now in VWCLAP. Oh, this looks as if let me check. I'm sorry, I have to yes, results visible. No, the results should not be visible, obviously. Competition mode and username, that's what I need. Okay, so we'll have a gold medalist again at the end of this thing. Here we go. Okay, it seems that the results will still be visible. Okay, so no, anyhow, there's not a lot of information in your replies, so no, maybe you shouldn't check what others are doing. Okay, so this is about, okay, full carry, not full carry. Okay, which one of the commodities are really, I mean, for which ones of these commodities the shape of the curve is mostly influenced by the cost of carry, and for which ones of the commodities the shape will be influenced by other factors such as expected future price change, hedging pressure, okay, and maybe storage problems and shortage problems. Okay, so so the idea is to sort this. Okay, so it's a sorting question. Okay, so the ones that are most frequently at full carry, okay, should be on the top, and the ones that almost never at full carry should be at the bottom. Okay, It's not so complicated actually. There's one there's one thing I'm not totally sure about. Okay, so apparently it's you need the the backslash at the end. hmm Okay, 15 answers. I think that's as good as it gets. So let me see. Most frequently at full carry to the ones that almost never at full carry. Okay. Um, that's pretty random, no? That's not at all what so actually everybody has a different combination. So this is the most frequent combinations, but the most frequent combination is only chosen by one person. Okay. So no, okay. Which ones are always at full carry? The ones that are at full carry are the ones that can be easily borrowed, that can be easily stored, okay, that are always available, okay, and for which you have now the storage costs actually don't count because they're part of the full. The one that is always at full carry is gold, okay. Gold is a precious metal, as you know, and the precious metals are, I mean, for precious metals and for financial futures, okay, this carry relationship almost always holds. But gold is almost a financial product, if you want. It's an investment product, and that's why that gold is clearly the one that is always at full carry. Okay, which one is the one that is almost never at full carry? It's electricity. Okay, why electricity? Because it's almost impossible to store. You can of course charge a battery, but you'll have massive losses if you do that. Okay, so the value goes down substantially if you try to store it even over one day, and you cannot really store it over 6 months. And it's highly cyclical. The demand is highly cyclical. Okay, in the summer in the US, everybody switches on the air condition, and the demand goes up. In the winter, they do the heating, and in between, they don't need. So you have a huge cyclical component. You have also cyclical component within the day. So electricity is the one that is worst. Okay, never at full carry, and gold is the one that is always at full carry. I should maybe write this down somewhere so that let me open Excel. Yeah. Okay, so gold is on the top. Okay, and then we have how many? We have five. That's five. We have electricity. Okay, now in between it's a bit more complicated. Okay, we said cattle. Okay, cattle is also difficult to store, and cattle. Okay, it's a bit easier to store. Okay, I mean you can keep your cattle a month. Your electricity you cannot, and also the demand is not as cyclical. Demand and supply, you can more or less raise these cattle everywhere, and people eat the same amount of beef throughout the year. So there's not so much of a cyclicality here. And then we have wheat and oil. And wheat and oil, I was not quite sure about which one is wheat and which one is more frequently at full carry, but at the moment both are are not at full carry. At the moment, both are in backwardation, and full carry implies a contango, remember, because you have basically the financing costs and the storage costs. But I think it's in this order, okay? Wheat is a more cyclical commodity, so you have the harvest time and you have a higher supply and then the prices go down. That you don't have for oil. And wheat is a little bit more complicated to store than oil, and it loses value over time if you store it, because the quality goes down. Oil, you can, you can store it forever. So that is for me the ranking. Okay, but I mean the things that blow it up so that you can see it. I'm not sure how much you can see all of that. Gold, that you should know that gold is always at full carry. Gold and precious metals are almost always at full carry, which means that the slope of this futures curve is almost always exactly the interest rate. Okay, it goes up with the risk-free interest rate. If it doesn't, you can have these investment banks that will carry out, cash and carry operations. Very simply, they can enter in the cash and carry operation, and that's going to make prices move back to the full cost of full carry slope. Okay, electricity, again, it's the one that is almost never at electricity. I misspelled here. Okay, but electricity. Okay, and in between, it depends on availability. It depends on the easiness with which you can short these commodities, and it depends on storability. Okay, so that will be the order. Okay, move on. Okay, now we are talking about calendar spreads. Okay, and so remember, okay, it's a long and a short position on the same commodity, but for different dates. Which one will make money if contango increases? Okay, so again, the calendar spreads or intra-commodity spreads, they the purpose of these things is to place a bet on the shape of the curve. Okay, and now we want to place a bet on an increase in the slope contango. Okay. I hope that you can answer correctly here. That's a simple question. Please. 15. Let's get to 15. Okay, 15. 16. Wow. So that's not good. Okay, so we want to make money if contango increases. Okay, so we want to make money if the short contract, the nearby contract, goes down, and if the far out goes up. Okay, so if that is the position, okay, we need a short position on the May contract and a long position on the September contract. It's from last year. I should have changed the years, but I think that's not a big deal. Okay, so actually most of you have given the wrong answer. Okay, hugely disappointing. Why? Why is that? Can you maybe explain your thinking here? Okay, I would be curious about your thinking here. Okay, what's what's the thinking? Or is there no thinking? What's the thinking? Please, I need a feedback on your behalf here, okay? Because that was a simple one, no? I mean, I thought it was a simple one, okay? We want to contango increases. It means the slope increases, huh? And if the slope increases, it means that I mean, maybe everything goes up, okay? But even if everything goes up, it means that the short one goes up by less than the long one, okay? Nobody wants to answer about the thinking here, okay? or you just randomly choose an answer, because I told you that participation is more important than the quality. Okay, it's true, but still, it would be nice to have a correct answer from time to time. Anyhow, I mean, that's, I mean, you need to think, I mean, somehow you need to try to understand what's going on before the exam. Otherwise, I anticipate problems. So just as a, okay, as a warning here. Good. Okay. Enough of next one. It's gonna become okay. So try to understand this, because it's gonna get more complicated. Okay. So we are short May cattle and long September cattle. Okay. So is this a bull or a bear spread? Now that's a complicated one. I think I should explain a little bit. Okay. So what is a bull and a bear spread? But it depends on, somebody else. Okay. It depends on what kind of commodity you have. Okay. If you have a full carry commodity and prices go up, the far out goes up more than the nearby. Okay. If you have cattle commodities such as cattle, okay, what will happen if prices go up? It's mostly the short-term prices that go up, and the long-term prices will actually not react. Okay. So again, if you have a full carry commodity, if prices go up, it's gonna get steeper. If you have cattle, if prices go up, the slope is going to get flatter. Okay. Now we have a position that benefits from short May, long September. Okay, so we would benefit from a steepening of the curve. Okay, given that we have a cattle contract, okay, the curve will steepen if the prices, okay, and that's the answer. Okay, 15 answers, presumably randomly distributed. No, not randomly distributed. Actually, the majority give a wrong answer here. Okay. It's worse than random. Okay. Already for the last question, we had worse than random. So I don't know what's going on here. Okay. Let me try to, okay, explain again. Okay. So you have cattle contracts. Okay. If prices go up, it's mostly the short-term prices that are going to change. The long-term prices are going to be flat. Okay. Okay. Now we have a spread. Okay. So we have a spread. So if prices go up in parallel and down in parallel, nothing is going to happen for us. Okay. We will not lose or win money. Okay. But if we have we are short in the nearby and we are long in the far out. Okay. So that means that we are placing a spread, a bet on an increase in the slope, like in the previous question. Okay. If contango increases, we make money. Okay. Now, we are in the cattle market. Okay. So when does the contango increase? Contango increases, wait a second. So short in May, contango increases if prices go down. Okay, because if prices go down, it's going to be mostly the short-term prices, and the long-term prices are more inert. Okay, they stay where they are. Okay, so if prices go down, it's going to be okay. So if for some reason there's an oversupply at the moment, okay, prices are going to go down. The long-term prices will not going to not react, because the oversupply will be overcome in the long term. So prices go down, the slope increases. Okay, we make money. Okay, so if prices go down at the same time, the slope will increase. Okay, so we make money. Okay, so it's a bear spread. Okay, it's a position that is in principle hedged against price changes. Okay, but because price changes are normally accompanied by slope changes. Okay, but I mean, that depends on the commodity. In some commodities, the slope goes up if prices go up. These are the full carry ones. And in other commodities, the slope goes down if prices go up. Okay. We will make money in this commodity if prices go down, but because if in cattle, if prices go down, okay, they mostly go down in the short term and not the long term, and that means the slope goes up. Okay, I hope that was clear. If not, ask questions, guys. Okay. Again, that's the only reason for why we don't have a YouTube tutorial here. Okay. Okay. Some of you, actually the majority of you, seem to have some kind of misunderstanding here. Okay. I mean, that was a bit of a complicated question, I have to admit, but I mean, given what we have done before, I mean, and if you do one by one reasoning, normally you should come out with the right answer. Okay. Bon. Move on. We'll move on. Okay. So we have another 2 questions. Butterfly spread. Okay. What is a butterfly spread? Remember, that's a bet on the curvature. Okay. So we have 2 contracts in the middle and we have 1 contract on each side. Okay. So depending on what is the direction, okay, we are placing a bet on the curve becoming less curved, okay, or more curved. Okay. Okay, so if you want to place a bet on the curve becoming more curved, we will take 2 long contracts for the middle maturity and a short contract for the short and the long one. Okay, because then, okay, if prices go like that, not sure you can really see what's going on here, but if prices go like that, then we can make money. Okay, let me see what's the right answer. I have to figure it out. Long January, long April, short September. Long, okay, short January, long April, long short. Okay, short. Yes. Okay, I think I found the answer. Okay, butterfly. Okay, think about the butterfly. Okay, so there's a big part in the middle and there's 2 wings. Okay. Okay. Good. We have 18 answers. Wow. Okay. I'm afraid. Great. 61 correct answers. Okay. Apparently my speech helped a little bit. Okay. Yeah, of course. I mean, the only answer here that has long, short, long, okay, it has to change twice. Okay, is that one. Okay. Why is long, long, short? That's not a butterfly spread. Okay. Because now if the curvature change, I mean, this is like a calendar spread. Okay. This is a calendar spread that is hedged because you have 2 long positions with slightly different maturities. Okay, and then you have a short position in the long maturity. Okay, so that's not a butterfly. Butterfly is a big one in the middle. Okay, and then 2 smaller positions. Okay, half the size of the middle one in the opposing direction. Okay, and again, that's a thing that's totally hedged against price increases or decreases. Okay, but it's a thing that is gonna change in value if the slope goes up and the slope or goes down. Okay, so in this case, long January, long September, short April. Okay, so actually here we're placing a bet on the slope becoming flatter. Okay, because we think that the middle one goes down and the outside ones are going up. Okay, again, it can, overall it can go up like this and do that, or it can go down and do that. That is not what we are anticipate. We don't know what is going to happen to the overall price, but we think that the shape is unusual. Okay, we think that the shape shouldn't have a kink with April. Okay, so we think the April one is too high compared to the September and January one. And that's the information that if you're convinced about this and you can see how we can, use statistical analysis to, look at historical data and see that the kind of kink we have is highly unusual and that it usually goes away, then we can make money. Okay. With a butterfly spread that is long January, short April, and long, we place a bet here. This is what I just said. Okay, we place a bet on which change in the futures curve. let's see. That's gonna tell me if you're listening to anything I'm saying, okay? Because it's I just gave it away, okay? I just explained exactly this question, okay? So what is the bet we're placing here? Steepness, curvature. Now what is going on? Nobody nobody was answering, huh? So answers are coming in more slowly, but I hope you're thinking a little bit more. So hopefully quality. Let's go to 15 as usual, huh? And it's the last question. So that's going to determine the winner, the gold medalist. Okay, here we go. Okay, let me see. I'm really afraid. Oh, that's almost perfect. So that means that you really don't listen to what I'm saying, okay? I don't know if it's an English issue or it's my accent or you're totally lost from the start. I don't know, okay? But I think there's going to be a problem with the exam, okay? So what are we doing? It's a butterfly spread, okay? So as I just explained, okay, butterfly spreads are about the curvature, not about the steepness. Okay, so you can forget about the steepness answers. Okay, so answer 1 and 4 you can eliminate. Okay, the steepness, if you want to place a bet on steepness, you invest in a calendar spread. Okay, short one, long the other. Okay, or the opposite. Okay, so reply 1 and 4 should you can forget about them. Okay, and then we have 2 replies that refer to curvature. Okay, so now we have to figure out, okay, what are we long in and what are we short in. Okay, so we are long January, short April, and long September. Okay, so we short the middle contract. Okay, which means we place a bet on the middle contract decreasing more than the January and September contracts. Okay, so we are normally the shape of the curve is like that. Okay, so actually, okay, we place a bet on the curvature becoming lower. Okay, normally the curvature is like that, and then if it's getting flatter. Okay, so we speculate on a decrease in the curvature. Okay, well, 4 correct answers. Who is the winner? Who is the winner? Okay, we have 3 winners with 3 points each. Okay, no, 2 winners. Okay, not too bad. Okay, for 5 questions. Okay, but still, a pity that you didn't enter your name, because I mean, you TTV. I don't know who's that. Or HTA. Even the winner here has not given his name, which means that I cannot use your answer in the participation grade. Okay. Let's see how we're gonna fix that, but that's a pity. Good. Back to the class. What time is it? Maybe I should give you some rest. Okay, so cattle spread. Okay. Yes, let's quickly wrap up, okay? Because we have an entire other session on investment in commodities, and that's important for you. It's a finance class after all, and not a commodity class. So let's wrap up with the use of commodities here, commodity futures. Okay. Very briefly, I mean, there's a lot of stuff still here, but I think we do not need to go into detail on all of that. Okay. So what we did so far is we explained how speculators, okay, place bets on these commodity future markets. It's all about speculators. And these speculators, again, they make sophisticated anticipations about what is happening to this curve, and then they place these bets where if what they have anticipated plays out, if what they have anticipated plays out, they will make money. Okay, and we have seen that they can, place a bet that doesn't depend on price changes. It only depends on the slope change and so on. Okay, good. Then, of course, we should also talk a little bit about how the hedgers should use these commodity futures, because remember, they are an important part of the market, and they are the ones that should look at the price signal and then react in terms of production or consumption. So who is basically what you have two types of hedgers. You have the producers and you have the consumers, okay, or the companies that need the commodity as an input material. Okay, now if you have the need, okay, if you need the commodity, you would use a short position. Okay, so you would wait a second. Okay, no, if you need, so this is not these are just a couple of examples. Okay, but I mean, you can have a long hedge and a short hedge. A long hedge means you have a long position in the futures, okay, but that means actually that you have bought the futures contract. So the long hedge is something that the consumers will do, and the short hedge is something that the producers will do. Okay, so yeah. Okay, so if you have a silver mine, okay, and you know that you will produce silver, obviously you will sell future contracts in silver. And if you have a manufacturer of film, or for some other reason you need silver as an input material, then you will buy futures. I mean, that's pretty obvious. Okay, now here is a calculated example. I let you go over this. It's quite obvious. We did this at the very first day for the bakery. And obviously, if you buy a futures contract, you are hedged against future price movements because you have locked in either the delivery of the commodity, or you have locked in the contract that changes in value as the spot price changes, and the change in value of this contract will exactly compensate you for the changes in the spot price. So even if you don't ask for delivery, even if you offset your contract, you will be hedged, because basically the gain you make on the contract will compensate you for the price change in the spot market. Okay, so that is pretty obvious, and the same thing is pretty obvious for the short hedge. Okay, so if you are this is again a silver mine. Okay, so obviously, if you anticipate a certain amount of silver output in the future, you should just forward sell. And then again, it really doesn't depend on whether you deliver to the warehouse for a fixed price, again, which happens only very rarely, or if you just offset your contract and lock in a gain or a loss that will correspond actually exactly to the difference between the spot price and the price that you locked in a long time ago. Now that's pretty obvious. Okay. Now, one problem with these commodity markets is that the products that are being traded there, as we have said at the beginning, are very, very standardized, homogeneous products. Okay, so it's cattle of a certain size in a certain location, or it's a certain type of oil, and in reality, producers may not need or may not produce exactly the same quantity. Sorry, the same quality. Okay, so maybe as an oil producer, you're producing a sort of oil which is not exactly the one that's Brent, that is being traded on these future markets. Okay? So that means, of course, that your hedge is not perfect. Okay. Because normally these prices will all move in the same direction, because this type of oil, will be a substitute. If you have a slightly heavier oil, a slightly lighter oil, you can probably burn it in the same kind of electricity plants. But there can be situations where you will have a squeeze on one or the other of these markets. So you can have situations where suddenly these price relationships that are very constant over time go apart. So cross hedging is the strategy of hedging your risk with a futures contract that is not exactly about the exact same commodity, okay, but a very closely related commodity, and for which the price normally evolves in parallel with the price of your commodity. So that's cross hedging, okay. But then okay, so I mean that's the most important part of cross hedging. Okay, there's also, I mean, it's just a mismatch between the hedge contract and the risk you are hedging, and the most important mismatch is the quality mismatch. Of course, there can be a quantity mismatch, because these contracts are very large contracts, as we have seen. So there's always going to be, a part that is either you overhedge or you underhedge. And maybe also in terms of maturities, you want cattle to be delivered in, I don't know, July, but there's no July contract, so you have to use the contract that is not exactly of the same maturity. That's pretty obvious. Okay, now the problem appears. Okay, the problem appears when you have to think about, okay, how do I hedge a risk that is not exactly correlated to the risk of the futures contract. Okay, so if I'm an oil producer, I produce some type of oil which is closely correlated but not perfectly correlated to the oil that is, specified in the futures contract. Okay, let's suppose I sell a certain quantity of oil, I produce a certain quantity of oil. Okay, should I forward sell exactly this quantity in the slightly different contract? Okay, so what is the best hedge quantity that I need to implement? Okay, and the answer is no. Okay, the answer is no. If you have not a perfect correlation between your risk and the risk of the futures contract, okay, you should not buy the same amount of contracts. You should actually buy a lower quantity of the futures contracts, because if you buy exactly the same quantity of the futures contract as your production, okay, but both are not perfectly correlated, okay, you will actually overhedge, okay, which means that your combined position, your production, okay, and the futures contract that you have will be more risky than necessary. Okay, so actually you can calculate the optimal hedge ratio. Okay, how many futures contracts do I have to buy per one quantity that I produce, and you can calculate that this optimal hedge ratio is always smaller than 1 if there is an imperfect correlation between these two contracts. And the smaller, so if you have only a very weak correlation between the price of my commodity and the price of the futures contract that I use to hedge my commodities, then you should only buy a small amount of this futures contract compared to the amount of production you have, because if I mean, again, if the risk is not correlated, I mean, the futures contract itself is going to be risky, and if you buy a futures contract with a risk that has nothing to do with the risk that you have, it's easy to see that you will introduce additional risk, okay, into your combined position. There might be some squeeze on the futures contract, okay, and suddenly you will have a massive risk from your futures position that has nothing to do with the risk of your the price of your commodity. Okay, so this is about the hedge ratio. Okay, and that's what I'm doing here with soybeans. Okay, but so here we have a calculation of the hedge ratio and so on. But I mean, the key message is don't overhedge. If you have a risk that is only weakly correlated to the futures contract, then you should buy a much smaller amount of futures contracts to hedge your own position. Okay. Now, let me just finish with one. Okay, where's the? Yeah, sorry, I'm not okay because I. Okay, yes, that's the thing that I wanted to explain. Okay, so typically, wait a second, I have to. Typically, typically, if you have a producer, okay, you have a lot of future. You have a lot of future production at different dates. Okay, and the question is, how do we best hedge this? Okay, so there are two strategies actually of doing this. One is, of course, to buy a lot of future contracts with future maturities. Okay, and that's called a strip hedge. So basically, for every production, I buy a future contract that corresponds to my production date. Okay, that's a strip hedge. Okay, often that's not what the companies want to do. In particular, if you are in a futures market that's not very liquid, simply because, as we have seen, there are not many contracts for the far out maturities, and the bid-ask spread is very high, and the prices are not very precise. Okay, so people don't want to buy these very far out future contracts. So the alternative is, of course, to let's suppose you have 1 year of production, okay, but you can buy a contract for the first month, okay, that expires at the first month and with a quantity corresponding to the entire year, okay, and that's called a stack hedge. Okay, now if you do that, of course, so you will have to reduce your position throughout the year. So you will have, let's suppose we produce, I don't know, 100 over the year. Okay, so let's produce 1200. Okay, over the year. Okay, so in the first month you will have produce 100. Okay, so you will reduce your futures position by 100, and then the remaining futures you will roll them over. Okay, so you will actually sell the futures or offset the futures that you've bought with a short maturity and buy futures with a slightly longer maturity. Okay, so you will not hedge at one point all the different maturities. Okay, but you will hedge only the short. Will buy only futures with the shortest maturity, and then as time goes by, you will roll them over. Okay, and you will sell the ones that have basically become too short, and will buy another one that is longer. Okay, so that's the stack hedge. The strip hedge, and the problem with a stack hedge is that, of course, you have to always buy new futures. Okay, and that means that if you have some kind of price problem in the futures squeeze, okay, these big price movements that we have seen, then this strategy can sometimes go wrong, and that is what happened actually occasionally in the past. Okay, so there is a lot of hedge disasters actually, where the hedging strategy went totally wrong and actually led to the failure of a company. The most famous case is the Metallgesellschaft case. This is a German energy trader who implemented this stack hedge. Okay, so a position where they had to roll over these hedge contracts, and the prices moved in the wrong direction, okay, and they lost so much money on the hedge position that they went bankrupt. Okay, I mean that's of course a stupid way of hedging. In principle, hedging should reduce the bankruptcy risk. Okay, you're hedging to reduce your risk, yeah? But sometimes these hedge positions can go terribly wrong, and then you end up adding risk. Yeah? And in particular again these stack hedges, where you don't buy right now futures contract for all the here, okay, stack hedge. You don't buy off. You don't buy the you don't forward sell the production as it arrives, but you sell only a contract that corresponds to a short-term maturity, and then you extend the maturity. This is a cheaper way of doing things, because these short-term contracts have a better price because there's more volume, but it's a much more dangerous way of doing this. Okay, let's have a break as usual, and then we will spend our last hour on how to invest in commodities, on commodity funds. I think that's going to be an interesting topic because now commodity prices go up again, and as typically if commodity prices go up, a lot of people want to invest in commodity funds, and you see a big increase in the volume of these commodity funds. But as you'll see, commodity funds are normally not a really good investment product. But okay, let's come back as usual in half an hour or a little less than half an hour. Okay. And discuss about that. A short break. Okay, guys, let's start again. So for our last chapter on how to invest in commodities and on commodity funds. So let me share my screen. Okay. So this is the slide desk number 5. Okay. And there's two big parts here. So we have a first part which is about funds in general, and then we have a second part about commodity funds. And I will be pretty short on the first part, except if we have some time at the end, but I'm afraid we will not. But I mean, what is important for the first part is just to understand the different types of funds that exist. Okay, I'm just checking if you can see what I'm doing here, but I think you can. Okay, so this is an overview of fund types that you can find in the financial markets. And it's there's a to give you a bit of an idea of what exists and how the commodity funds fit into all of this. So the first thing you have to understand is that you have regulated and unregulated funds, or weakly regulated funds, we should say. Okay. The difference is who can invest in these funds. So funds actually, this regulation goes back a long time to the 1930s, where funds were totally unregulated and where a lot of people lost a lot of money from investing in unregulated, very risky funds. Okay, and then the U.S. government has implemented a very strict regulation of funds. So if small investors want to access funds, they are only allowed to buy funds that are heavily regulated. Okay, if you want to if you want to set up a fund that is very risky, you will not be able normally to sell this fund to small investors, and that makes sense. So you have this difference: regulated funds, everybody can invest; unregulated funds, or weakly regulated funds. I mean, these funds are only regulated to make sure that they don't cheat or that they don't create risk for the overall financial market, but the individual risk for investors is not regulated. So you have these two different parts. So I mean, just to give you an idea, so the investors that are allowed to invest in these unregulated funds are called normally they're called accredited investors. In the original regulation, there was only one type of accredited investors. That's now somebody who's called a super credited investor, because the regulation has, been softened over time. So previously, you had only two types of investors: the accreditors and the non-accredited. Accredited allowed to invest in everything; non-accredited only allowed to invest in safe regulated funds. Okay, so in the old regulation, the only investors that were allowed to invest in these risky funds were people that had more than 5 million in financial investments, so really rich individuals, or companies, institutional investors that had more than 25 million in investments. Okay, so in this case, if you can prove that, you can buy any kind of investment fund. Otherwise, you have to restrict yourself to these regulated funds. Now, this regulation has been softened, as I said, so now you have qualified client accredited investors. So these are smaller categories of less wealthy investors that can invest in somehow less regulated funds. But for our purpose, that's not really important. So the big classes of funds are really the regulated ones and the unregulated funds. Okay, in Europe, so that's the US regulation. In Europe, you have a similar regulation where this category is called the alternative investment fund category, and this is called the mutual funds. And the term for is the people who are allowed to invest in these alternative investments are called elective professional clients. And in Europe, it's not so much about the amount of money you can invest, but about your financial sophistication. So I think as a finance professor, even if I don't have a lot of money, I would be able to invest in Europe in very risky stuff. Whereas in the US, I need a lot of money to invest, okay, to be allowed to lose a lot of money. So what are these funds in detail? But the regulated funds are called mutual funds, or you have a new category that's called exchange traded funds. And within the mutual funds category, you have closed-end funds. Closed-end funds are funds where you cannot get your money back from the fund. You have to sell your shares in the fund to exit the fund. And you have open-end funds. Open-end funds are funds where the fund is willing to buy back your shares. So he's willing to pay you back your money. In a closed-end funds, some closed-end funds, you can never get back your money. You always have to find somebody else. Some closed-end funds have a limited lifetime. So after maybe 10 years, they will be closed down, and then you're getting your money back. Okay. So that's the mutual fund world, if you want. And then you have exchange traded funds, which are, as the name indicates, which are essentially closed-end funds that are listed on the stock market. So you can, a normal open-end fund, if you want to take your money out, it takes 2 days because you have to tell the fund, and then the fund is going to sell securities. And then once they have done this, they can pay you the money. In an exchange traded fund, you can buy it in the morning on the stock market and sell it in the afternoon because it's traded like a normal stock. Okay, but an exchange traded fund, so it's similar to a closed-end fund in this respect, because closed-end funds are also sometimes traded on the stock market. Okay, but an exchange traded fund, or ETF, is also an open-end fund, just not for everybody. So an ETF is an open-end fund for a certain number of special investment banks called authorized participants. So these special financial intermediaries, APs, authorized participants, they are allowed to invest more money in the fund in exchange of shares, or take their money out. Okay. So certain investors can take their money out or invest new money, but the normal investor will only be able to buy these shares on the market. That's an ETF, okay? And it turns out that we have actually quite a lot of commodity ETFs. That's why it's important. So an ETF, again, has this special structure, and an ETF is normally also an index fund. So it's not a fund that a fund manager manages, okay, but it's managed by a computer, and the purpose of this fund is not to outperform the market or to make a high return. The purpose of this fund is just to replicate a stock market index, okay, not beat the index, not underperform, replicate the index. So this is called a passive investment strategy, and most exchange traded funds, again, are implementing this passive investment strategy instead of having an actively managed investment strategy, where you have a famous fund manager who has, some ideas about where prices are going and tries to exploit the underpricing and overpricing. Okay. So that's the regulated funds. What do we have in the unregulated funds? There's basically two subgroups of unregulated funds. One is the hedge funds. So hedge funds are basically defined as unregulated funds that invest in liquid strategies, and therefore are normally an open-end fund. Maybe not open-end, at the end of every day, but basically at the end of every month, the investor can normally take the money out. Okay, so a hedge fund is an unregulated fund that does anything that can be quickly exited. So they invest in bonds, they invest in commodity, they can invest in commodity derivatives. We'll see it in a minute. They can invest in stocks, they can invest in derivatives. They do a lot invest in derivatives. Okay, but the important thing is that these positions are all quite liquid and can be exited, maybe not within a day, but within a week or within a month. Okay. If you have very illiquid positions, okay, you would call a fund a private equity fund or a private equity fund. So private equity fund is a fund that invests in the equity of private, which means non-listed companies. Okay. And of course, these securities are not liquid. You cannot easily sell this. And that means that the fund needs to be a closed-end fund because you cannot allow the investors to take out their money if you cannot, get your money back from where you have invested it as a fund. Okay, so private equity funds are closed-end funds. Normally, they have a 10-year lifetime. Hedge funds are normally open-end, or at least to a certain extent open-end. Okay, and then you have within this industry, the private equity industry, you have two subgroups: the venture capital and the buyout industry. We will not go too much into that. You also have private debt funds that are structured in the same way, but they invest in loans, so they basically function in the same way as a bank today. So that's the private equity industry, hedge fund industry. And then you have CTAs. So what is a CTA? A CTA is a commodity trading advisor, and that's basically a subgroup of hedge funds. Okay, but this is a subgroup of hedge funds that invests in futures. So this could be financial futures or commodity futures. But the important part is that futures are not regulated by the SEC. Okay, so the CTA is not supervised by the Security and Exchange Commissioner, which is the main regulator of the US financial markets, but it is regulated by the CFTDT, okay, the Commodity Futures and Trading Commission, this specialized regulator that is supposed to supervise financial commodity derivatives. So that makes a difference because regulation is very important for these funds, and actually these CTAs, I mean, for practical purposes, they are basically they are called commodity trade advisors. Okay, but actually, a lot of these CTAs do not even invest in commodities. They just invest in futures, and most of them are financial futures. But remember that financial futures have been defined, the financial contracts have been defined by the US regulator as a commodity for no good reason. So it's a way of escaping the regulation of the SEC, which has been quite tough on hedge funds. So if you don't want to be regulated by the SEC, you just shift and you go to the CFDT and you register as a commodity trade advisor. So, but of course, some of the commodity trade advisors also invest in real commodities. Okay, so it's pretty confusing, but the big picture is that you have regulated funds and unregulated funds. And sorry, it's really cold here. And you have funds investing in liquid strategies, and these are typically open-end funds, and then you have funds investing in less liquid strategies, and these are typically closed-end funds. And maybe, yes, the last distinction, you have actively managed funds where you have a fund manager who tries to beat the market, and you have passive funds where you just have a computer who tries to replicate the performance of a stock market index. Okay, maybe a very short comment. So there's a lot of information here. A very short comment on the performance of funds in general. So I don't know if you have been told about that, but I mean, there's a lot of financial research about do actively managed funds outperform a passive investment? Okay, and the answer is clearly no. Okay, an actively managed fund cannot beat the stock market. Okay, and the reason is that the fund manager is getting paid quite a bit of money. Okay, so the actively managed funds normally have a fund management fee of something like 1.5% per year. Okay, and a fund management fee of 1.5% per year, if you invest over a long horizon, can take away a lot of your money. Let me just give you an example. Okay, so if you invest 100 euros and you invest it in the stock market, and the stock market is, increasing by about 8% per year, okay, you will get about 1,000 euros over 30 years. So that's, let me try to, where is your, so this one I have to move here. Shrink it. It's my calculation sheet. Up. So here's what I did. Okay, I just took 100 and I multiplied it with 1.08, so 8% per year, and then I took exponential 30. So after 30 years, you can transform your 100 euro investment into a 1,000 euro investment. That's the kind of calculations that most people's retirement plans are based on. Unfortunately, I mean, if you invest your retirement plan not in the stock market, but in a mutual fund, okay, that invests in the stock market, it turns out that the mutual fund will underperform the index. So here, if we look at that picture, okay, let's for the moment that's the same. But if you look at the picture, we see that altogether, if you look at the average fund, they underperform by something like 1.5% a year. Okay, what is 1.5% a year? It's almost exactly the fund management fee. Okay, so it seems that on average, what the funds are doing, they are just putting your money in the market, okay, and they are getting paid for it, okay, for basically doing nothing. And that's, of course, a problem, because now if we invest in a fund that that basically replicates the return of the market, but subtracts 1.5%, then we will not make 8% per year. We just make 6.5%. Okay, and if we make 6.5%, maybe lose, but not exactly. Okay, over 30 years, we lose a lot of money. Okay, we lose basically 1/3 of our investment. Okay, so your retirement will be a little bit more difficult. And that's, of course, the problem with these mutual funds. And that's the reason for why a lot of people now switch from actively managed funds, which we know to underperform, to index funds. Because if you invest in an index fund, you know that you will replicate the index. Index funds also have management fees, but the management fees are much, much lower, something like 10 times lower. Okay, so you would pay something like 0.1% instead of 1.5%. And that makes a big difference. I mean, if we pay 0.1%, then we make a 7.9% return, and then we even after 30 years get quite a bit of money. There's quite a bit of money left. So okay, so people are moving more and more from this actively managed funds into so-called passive funds or index funds, simply because more and more people realize that actively managed funds cannot beat the market. Okay, why is it so? If you look at so passive funds, I think now are something like 15% of the market. So the majority of the fund is still active. Why are so many people fooled by actively managed funds? Now, the reason is very simple. The reason is that the fund management companies, okay, they will close the funds that underperform. Okay, so they start 20 funds, and then they let these funds perform over a year. Half of the funds will overperform, half of the funds will underperform, because there's a random. Actually, more than half of it's more like 40% of the funds will overperform, 60% will underperform. Okay, but what you do, you basically close down the underperforming funds, and then you open some new funds. Okay, so at the end of next year, you have again 20 funds, 40 have overperformed. Okay, 60, well, you will see they are just being created. Okay, so you do this year after year. You systematically close the underperforming funds, and you only keep the overperforming funds. After some time, you will have a list of funds that are on sale, and you will present this to the investor, and you look at the returns of all of these funds, and they all made positive returns in the past. Okay, and then you will say, okay, great, this is a wonderful investment company. Apparently, they are able to systematically outperform the index. But actually, no. Okay, they only have eliminated, killed, cancelled, okay, liquidated the funds that did not perform well, and kept the overperforming ones. And by doing this, they give the impression that actually they can really overperform, but it's based on a selection bias. So it's an old trick that the industry uses to give the impression of high performance, despite the fact, and in reality, they are not performing very well. Okay. Okay, so it's a short explanation, very condensed message on funds. Okay, but I mean, I would not advise you to put your money into an actively managed fund. Even if the actively managed fund has performed well in the past, okay, we know, again, you can look at the data, we know that there is no correlation between the past performance and the future performance. Look at the papers in the Journal of Finance, in the Journal of Financial Economics. You have lots of papers that look at the data. So, of course, they have to go back and you have to check which of the funds have been closed and what is the return of these funds that have been closed. But if you do that, you realize that these funds as a whole, actively managed funds, underperform, and that for these funds there is no correlation between the past performance and the future performance. Okay, so actually there's even a negative correlation. So funds that have performed very, very well in the past tend to perform less in the future. Okay, so it makes no sense whatsoever to look at a list of funds and pick the ones that perform very well and put their money there. This is, I mean, it's a very natural thing to do, and a lot of people do it. But we know that by doing this, you will not select the good funds. Okay, and given that most people know that, okay, or more and more people know that, more and more people are now switching from an investment strategy based on actively managed funds to an investment strategy based on passive funds. Okay, good. So let's skip all of the rest here of the explanation about what is, the fund management industry and what is a hedge fund and so on. Okay, and let's really look at the commodity funds. Okay, so essentially you have two types of commodity funds, and then of course you can also invest in commodities by investing in companies that produce commodities. So you can buy an index of commodity firms. Okay, and that is probably the best way of investing in commodities. We'll see it in a minute. Okay, but if you want to directly, I mean, you never directly invest in commodities if you invest in a commodity fund. Commodity funds normally invest in commodity futures. Okay. You have very rarely you have companies that directly invest in commodities. So you have a gold ETFs, okay, okay, that do directly buy gold. Okay, so you have some gold ETFs buy gold futures. Okay, but you also have gold ETFs that go to the gold market, take the gold bars, buy it with your money, and put it in, in the cellar of a bank. Okay, but normally the index funds only invest in futures. Okay, so that's the index funds. Okay, you basically don't have actively managed mutual funds that invest in commodities. That's just not maybe that exists, but it's not an active. It's not a really big market. Okay, I don't think it exists actually. Okay, so if you are a small investor and you want to invest in a commodity fund, you will normally invest in a commodity index fund. Okay. if you want to invest in an actively managed strategy dealing with commodity futures, commodity prices, and so on, then you have to invest in a CTA, okay, commodity trading advisor, basically a hedge fund investing in commodity strategies. But that, for that, again, you have to have more than 5 million euros dollars in the US, or you have to be a super qualified investor. Okay, these strategies are rightly perceived to be very risky, and therefore only rich investors are allowed to invest in this. Okay, but then of course you can invest in, as I said, commodity businesses or in actively managed funds that invest in commodity business, and we see that that's probably the best way to if you want to get exposure to commodity risk, that's probably the best way of doing this. But okay, so who is active where? Okay, so if we look at the futures contracts, okay, we have the short-term maturity, the mid-term maturity, and then we have the very long-term maturities. Okay, so the different investors will invest, or different types of funds will be active in different maturities. Okay, so what you have is you have basically the CTAs, the hedge funds, that are mostly active in this very short end of the futures curve. Okay, so the nearby and the next one. Okay, but not much further. Okay, so they implement very rapid trading strategies around these short-term futures. Okay, the futures that are soon expiring. Then you have the index investors. Okay, so these are the regulated funds, commodity index funds, that they will invest in more long-term strategies. And finally, you have the physical hedgers, consumers and producers, and they will tend to be active in the far out contracts that are okay with a 2 or 3 year maturity. So this is for the oil index, okay, WTI. And this is a picture that's been taken in 2012. So you can see that the 2012 contracts, mostly CTAs, then between 2013 and 2014, so 2 years, 1 to 2 year maturity, you have the index investors, and then in the end you have the physical producers. Okay, so let's first look at how a commodity index is constructed. Okay, so here you have a list of indexes. Okay, you have the Dow Jones Commodity Index, you have the Goldman Sachs Commodity Index. It's now called the S&P Goldman Sachs Commodity Index because it's been sold to S&P. Okay, and then you have the Reuters Jefferies Commodities Research Bureau Index. So these are the traditional commodity indexes. You can see they date all from the late 90s or early 2000s. Nowadays you have many more, but we will talk about this. So what is the difference between these indexes? The number of commodities, but they are all broad-based indexes. So you have between 19 and 25, 24 commodities. You have different weighting and rolling schemes, and that's something we have to talk about because that's key to understand commodity indexes. Okay, we have the allocation, rebalancing frequently, and the roll period. Okay, so that all of that we have to talk about this. But let's look at first the composition of these indexes, and for that I have again looked at this in Bloomberg. Okay, so where's my okay? These are CTAs. Okay, this is the S&P Goldman Sachs Commodity Index. Okay, and what you can see here is that it is really extremely broad-based. Okay, you have nickel prices are crashing, huh? You have so this is as a function of the price. Maybe I can order it in terms of, no, it doesn't. No, okay, I don't want to order it as a. I don't want to order it in terms of alphabetically, but you can. The color tells you what's in there. Okay, so you have green agriculture, yellow energy, blue industrials. Okay, industrial metals, red livestock, and gray precious metals. Okay, so we have silver and gold. Okay, we have So there's 34 components now. Okay, so apparently the number of components has expanded because in my old table we only had 24. We have nickel and we have gold and silver. We have nickel, zinc, lead, copper, and aluminium. So these are the industrial metals. We have feed cattle, live cattle. These were our 2 contracts. And we have lean hogs. Okay, so these I think are the ones that need to be fattened. Okay, so these are the ones that it's like the feed cattle. We have different types of oil contracts and gasoline contracts. Okay. And we have agriculture, we have cocoa, okay, chocolate, coffee, corn, cotton, wheat, soybeans, sugar, and wheat again. So this is the CBOT wheat, and this is Kansas wheat. It's also on, okay, so it's a different delivery point, okay, so it's different. So the weighting is of these different components depends on the size of the market, okay, so these are essentially the largest commodity future markets, okay. So that's the distribution. So you can see that you really invest in a very broad range of very different commodities if you do that, okay. And you can also see that the performance in the last year hasn't been too bad. Okay. No, this is not the last year. It's 22. It has gone up a little bit. Okay, actually not all that much. Let me see if I can get a better graph. Normally that's the GP. Oh, this is something else. So now I'm back with the live cattle. Okay, so no, okay. Apparently they don't want to give me the. They don't want to give me the. They don't want to give me the long-term performance. Okay, so here the other Commodity Research Bureau Commodity Index. Remember the Rogers Commodity Index. There's a Bloomberg Commodity Index. Okay, so these are different. Let's look at this one. Okay, so here you can see this is a International Commodity Index total return. So this is an index that is much more heavily based on agriculture. Okay, you have agriculture, energy, and metals. You don't have precious metals here, and you don't have energy here. See, you have energy. Okay, but you can see that there is no precious. Okay, and what was the industrials? There's no. It's a different color code. Okay, but you can see there's much more azuki beans. I don't know what that is. Okay, so that's a Japanese. It's probably some special soybeans. Okay, you have oats. You have the famous orange juice contract. If you have looked at trading places, the Filmer recommended. This is the contract. Soybean oil, lumber, wood. Okay, good. You get an idea. Okay, so these are different types of indexes. Now, what is the strategy of these contracts? As I told you, these funds, these index funds, do not invest in the underlying commodity. So they don't buy live cattle. Okay, they invest in live cattle futures. Now the problem is what? There's 2 problems. First of all, if you want to enter a live cattle future, as I told you, in principle you don't invest money. Okay. The price is 0. Okay, it's a futures contract, so you don't put. You don't buy anything. You invest 0 money. You put, of course, up a little margin. Okay, but you cannot invest your money directly in live cattle futures. Okay, because the value of the future when you enter the contract, the value is 0. Okay, so what is the strategy of these funds? Well, first of all, the funds will have to invest the money in collateral. Okay, so what they will do is they will take your money, okay, and they will invest this in government bonds and in the margin. Okay, but the margin again is also normally remunerated simply with the risk-free interest rate. Okay, so actually your money goes into the margin and the money goes into government bond. Okay, and then they add a future contract. Okay, so they buy the risk, if you want, of the futures contract, but they really don't invest your money in the future contract. Okay, so that already tells you that the return that you will get on this fund will depend on the risk-free interest rate, because actually your money is invested in the risk-free interest rate, and then of course on the change in the price of the future contract. Okay, because you have entered the future contract. Okay, so you have a long position in the futures contract. So if the prices go up, you will make money. Okay, now first problem. Okay, so you cannot invest money in the futures contract because it's a contract that has a value of 0. So you have to put the money somewhere else, and then you just enter the futures contract. Second problem, these future contracts don't have an infinite lifetime. Okay, if you invest in stocks, you can put the money there and that's it. Okay, you don't have to worry about what happens in the future. I mean, maybe you worry about, but you can just sit on your money. Not the case with futures contracts. The future contracts, as time goes by, maturity arrives, and then as a hedge fund or as an investment fund, of course, you do not want to take delivery of the cattle. Okay, so you necessarily have to offset these future contracts, and you have to buy new future contracts. Okay, because you want to remain invested in live cattle. Okay, but of course, when the live cattle contract arrives as maturity, you cannot keep that contract. So you have to get rid of the old contract and you have to buy a new contract. Okay, and this is called the roll. Okay, so you're rolling your futures position. Okay, so when maturity arrives, you will sell the contracts with the short maturity and you will buy new contracts with longer maturity. And then you wait again, and then these new contracts the maturity will get shorter and shorter. Okay, and at some point you again have to sell them and you have to buy new contracts. Okay, this is the roll strategy. Okay, and this is what explained here. What is explained here? Okay, so to figure out what is the return of this type of commodity funds, the index is actually defining exactly how you need to roll. Okay, so you have to roll over a certain number of days. So the roll period here is 4 days. Okay, and so it's not exactly specified here. Okay, but so here, for example, Goldman Sachs is oh no, that's the rebalance. Okay, rebalancing means just the index is readjusted. Okay, so if again these indexes are supposed to reflect the importance of these commodities. So if some commodity becomes more important, they will change the weight. Okay, so okay, so they don't explain next futures delivery months. Okay, so so the question is what do you sell and what do you buy? Okay, and the rule is that you sell the expiring contract. Okay, and you sell it through in 4 or 5 days in the expiry months. Okay, so if it's a May contract, the delivery is something between 15th and 30th. Okay, and so you have 2 weeks at the beginning of the month. Okay, where you can still offset your contracts. Okay, I don't remember when the trading stops. All of this is explained in detail in these in the Bloomberg screens. Okay, but the trading stops somewhere in the middle of the month, and if you own the contract at the last day of trading, then you have to settle in cash or you have to deliver. If you can buy an offsetting contract before, then you can get out this way. Now, there is a precisely defined rolling schedule, okay, for these funds. So the index tells you how they calculate the return, okay. They have to define a rolling period for the calculation of their return. And of course, a fund who wants to replicate the index has to use the same rolling strategy. Okay, so what happens is in 4 or 5 days, just in the expiry months, the fund will have to sell all their expiring futures, or they have to buy an offsetting contract. Okay, and then they have to buy new futures with a longer maturity. Okay, and again, it's the next month with sufficient liquidity. So that's the relevant future. Okay, that will be bought if the old one expires. Okay, now that is of course a bit surprising, maybe. Okay, if you have in your idea the functioning of a normal investment fund, they put their money in some stocks and then maybe they sell these stocks again and put their money elsewhere. But here you have to constantly trade simply because these securities are expiring. Okay, so now let me actually, so there you have two times of actually you have three. Now we have understood, we should have understood that we have three components in the return of an index fund, a commodity index fund. Okay, one is the collateral yield. That's simple. That's the interest rate on the treasury bonds. That's where we really put the money. Okay, one is the change in the stock price. Okay, that's what I said before. We just have prices going up and down, and then the futures contract, and they make losses or make wins. Okay, but finally we also have the roll yield. Okay, what is the roll yield? These are the losses and gains that you get because you sell the expiring contracts and you buy the new contracts. Okay, now we have to understand when the roll yield is going to be positive and when the roll yield is going to be negative. And I think for that I need to again draw something. So let me pull up again this pretty primitive drawing tool. Okay, so let me illustrate. So okay, let's do it again. It's supposed to be a coordinate system, but it's not really nice. Okay, here and here. Now, yeah, not much better. Okay, so let's suppose we have a security, a commodity that is in contango. Okay, like that. Okay, what is the roll process? The roll process means you have to sell here. Okay, and then you have to buy here again. Okay, what does it mean for the roll yield if you're selling the short future and you're buying the long future? And if the commodity is in contango? Okay, I think I shouldn't ask questions. Okay, no real questions, just questions. Okay. Good, there's a question. I'm so happy. Okay, yes, that's exactly the problem. They have to sell at any price. Okay, and you can see that this is a very dangerous system because it means that other traders, they know exactly that there is forced selling over these 4 days. Okay, so if you have a very small fund, then this is not going to influence the prices. But if you have a very large fund, and these commodity funds some of them have really become very large, then you know that there's a lot of selling pressure exactly over these 4 days in the beginning of the expiry months. Okay, and that we'll see in a minute that this is something that has really, destroyed the returns of these commodity funds. But let's first think about the roll yield. Okay, so the roll yield is the losses or gains that you make, okay, if you always sell the short contract and then you buy a new long-term contract. Okay, now if the commodity is constantly in contango, okay, what does it mean? It means you sell at a lower price and you buy at a higher price. Okay, so sell low, buy high. Okay, that's not how the saying goes. Normally the saying goes buy low, sell high. So actually, if you're rolling the futures contract for a commodity that is in contango, you have always a negative roll yield. Okay, so I mean over time, okay, this contract will move to the left. Okay, so it looks like that. Okay, so over time, okay, this high price future will become a low price future because in the commodity that's in contango, but the nearbys have always a lower price than the far out. Of course, there can be superposed by overall level changes, but in the tendency, you will always buy high, sell low. You buy the long-term contract that has a higher futures price, and you sell the short-term contract that has, for which the prices have decreased. Okay, so that means that if you are in contango or you have a commodity that is in contango, the roll yield will be systematically negative. And that's a big problem. Now, of course, if you have a security that's in backwardation, you have the opposite phenomenon. Okay, so if you're like that, then you buy low and you sell high. Oh, okay, and you sell high. Okay, you would buy here and sell here. My pictures, maybe I should add buy and sell, but yeah, somewhere. Okay, maybe. Okay, okay, sell. Okay, I think I should give up on this. I'm just not good in. Okay, you sell here, and you buy there. Okay, sell, and you buy. That's the roll process. Okay. Now we know that most commodities are in contango. Okay, because if they are at full carry or close to full carry, but then the financing costs and the storage costs will produce a contango. Okay, and that means that actually, as an investment fund who invests in commodities, you will basically pay these financing costs and you will basically pay these storage costs. Okay, and that's obviously a huge draw on the overall return of a commodity fund. Okay, so the so if we sum up, okay, so that part, of course, the collateral yield will normally be positive. Okay, the change in the spot price, if the commodity, sometimes goes up, sometimes goes down, that should be on average zero. Okay, but the roll yield, if you are in a market where the commodity is in contango, the roll yield should be negative. Okay, so actually overall, it seems that the fund will provide a relatively low return. Okay, so and that's what we see. That's what we see if we look at the commodity. Okay, yes, if you look at the commodity fund returns. Okay, so people, okay, so sometimes you have two types of return indexes. Okay, so the ones I focused in, and that's the one we will only focus in the commodities, the Goldman Sachs Commodity Index. They have their total return index. Okay, so it's collateral return, spot return, and roll return. Sometimes people only look at the excess return index. So you take away the risk-free rate because you're not really interested in that. But the index that can be replicated, so that one cannot be replicated. Okay, that's the index that can be replicated by an investment fund. Okay, so as I said, okay, the roll return is always negative if we are in contango, and on average negative because on average the commodities are in contango. Okay, so here's just a stupid example. Okay, but okay, that it's pretty clear. Okay, so here you have the spot return. Okay, so that's this change in the spot price, and you have the roll return for the GSCI. Okay, so be careful. This is not the actual roll return. Okay, the GSCI, the index, has only been created in the 2000s. Okay, so actually over this period, the index there were no commodity index funds. Okay, so over this time, apparently, okay, a lot of future contracts were in backwardation and the roll return was positive, but actually over the more relevant time period, the roll return has become negative. Okay, now again, this depends a lot on the type of commodity. This depends on the hedging pressure. Okay, all of these factors enter into that. But I mean, one of the reasons for why these roll returns have become negative is that because there is so many financial investors now in these commodity markets, the price of hedging has decreased. Okay, in the old days, if you have a lot of farmers that want to insure, they had to, basically give high returns to the few speculators that were willing to absorb this risk. Now you have a lot of people, trying to put their money in the commodity markets, and that creates that tends to create more contango rather than backwardation. Again, if you are a financial investor, you invest long term and you sell short term. Okay, so that's driving up the long-term future prices and decreasing the short-term future prices. And again, it's okay. So the presence of a lot of financial investors will tend to increase the contango. Okay. Now, let me, because you asked the question and because it's a really interesting fact. Okay. Let me show you some details about this rolling period. Okay, so we said it doesn't seem like a good idea because other investors will know that these funds have to exit their futures contracts in 5 days. Okay, so here's the exact contract. Okay, so the GSCI, okay, the first nearby contract, okay, so that's the one that expires, is rolled into the next nearest contracts. Okay, so that could be depends on how many contracts you have during the 5 days from the 5th to the 9th business day in the expiry months. Okay, and that's of course curious because we have this pricing pressure. Okay, and what this graph here shows, it's from a paper, from an academic paper. What this graph here shows is that the prices dramatically decrease, okay, for these contracts exactly over these days. Okay, so this is from this is the compared to the, okay, so this is the spread between the March and the April contract. Okay, the March contract is the one that expires and the April contract is the one that the people invest in. Okay, and you can see that wait a second, so this is the period over which the roll takes place. Okay, and you can see that over this period suddenly the spread decreases, which means that the March contracts become cheaper compared to the April contract. And normally you have a contango. Okay, so normally you have more or less the same. Okay, and then you have a suddenly over this period, okay, the slope increases. You can also see it here. Okay, if you just look at the futures curve, okay, you can see that it's upwards, it's downward sloping quite nicely, but suddenly, okay, there's a sort of a kink. Okay, the March contract is much cheaper. Okay, on, okay, so that's the on the 7th. The 7th is in this roll period. Okay, so in this roll period you get a cheaper March contract and a more expensive April contract because that's what the trading requires. Okay, and so that's on the 7th, but actually we see that this kink will disappear outside the rolling period. Okay, so you can see it also here. So between if you have a normal day, not a roll day, the prices, there will be the March contract will be actually, let me see, will be, so it's downward sloping. Okay, so it's a backwardation, so the March contract is much more expensive. Okay, and suddenly over the roll period this this backwardation disappears. Okay, and you get a zero spread. Okay, which means that if you would roll over another period, okay, you would make a positive roll rate, but given that, because we are in backwardation, but given that we are rolling over this 5-day period at the beginning of the month where everybody knows that we are rolling, okay, the roll yield has is much lower. Okay, so this guy here, this is the, okay, this is I think a Chinese author. Okay, he calculates the actual performance of the S&P Goldman Sachs Commodity Index in blue, okay, given the rolling they did, and he also calculates what would happen if you have an earlier roll. Okay, so if you avoid this effect that suddenly when you want to sell the March contract and buy the April contract, the March contract becomes cheaper and the April contract becomes more expensive. Okay, and you can see that the performance difference is substantial. Okay, so if you have an earlier roll, you make a much higher return. Okay, here the guy specifies what is the losses. So you can see that the differences between the earlier roll and the later roll are not very important in the 90s and early 2000s. Why not? Maybe because simply there was not a lot of money invested in these Goldman Sachs Commodity Index funds. But in 2008, 2009, we have seen, as I told you, a huge inflow of money. And of course, now the prices react in this roll period. And that means that over this period, okay, the losses to investors because of this stupid rolling strategy have skyrocketed. 26 billion lost for investors because of this roll. Okay, lost for investors, gain for, of course, the commodity trade advisors that are on the other side of the deal. Now, this hasn't escaped, of course, investors, and that's why you have now indexes, okay, that prescribe more flexible and more intelligent roll strategies, okay, so designed to minimize contango and maximize the backwardation, okay, by varying the contract months, okay, so roll, maybe don't just roll just before of expiry, maybe you can roll a little earlier, okay, even maybe you can roll the second largest, the second near out contract, okay, so these types of roll strategies have become actually more frequent. So let me see somewhere here. Okay, so this is, for example, Invesco Optimum Yield. I'm not trying to sell this fund. I have no idea who they are. Okay, but okay, it's an actively managed exchange traded fund incorporated in the US. Okay, so they try to track this commodity index. Okay, 14 commodities, and aims to mitigate negative roll yield in its contract selection. Okay, so they try to avoid exactly this problem of having to roll mechanically. Okay, this futures portfolio. Okay, so that's an important thing to understand. Okay, so roll yields are first of all tend to kill the performance of these commodity funds, and even more so if you just mechanically stupidly roll these contracts, and basically then can be taken advantage of by other traders that know that you have to trade. Okay, but collateral return, that's not very complicated, it's just a risk-free rate. Okay, and here you have so you have a breakdown of the returns, okay, components for the GS CI. So for the different components, okay, you can see that the roll return is mostly negative, okay, except for energy and for livestock, because energy and livestock is often in backwardation, but for the others it's it's negative. Okay, collateral return, that's just the average interest rate over this period, so it's an old data. Okay, but it's not it's pretty high in this time. Okay, so but it's basically the interest rate. Okay, interestingly, you can see that the roll return for precious metal is exactly the collateral return. Okay, and that is because precious metals are at full carry. Okay, we said for precious metal the prices go up by exactly the interest rate. Okay, so that means if you sell the long and you buy the long and you sell the short, actually the amount of money you're losing is exactly the interest rate. Okay, so that means that actually for precious metal the roll yield and the collateral return will tend to offset each other. Okay, which means that in the end, what you are placing a bet on is just a change of the spot price. Okay, so the interesting, then you have the spot returns. I mean, this depends just on the scarcity of the commodity, but the total return is, the substantial part of the total return is this roll yield, which for some commodities can be quite high or quite negative. Okay. So what is the overall performance? Let's conclude with that. What is the overall performance of a commodity fund or of commodity funds as in general? Pretty bad. Okay, this is the Goldman Sachs commodity index compared to the S&P 500. The blue one is the S&P and the white one is the commodity index. Okay, so it is clear that in general a commodity investment is not a good investment. Okay, and the reason is that we have seen before that in the long run commodity prices in the past have always gone down. And if you invest in these commodity indexes, basically that's what you're investing in. Okay, we said, okay, on average, the roll return and for most commodities, the roll return and the collateral return should be more or less the same. But actually, for difficult, expensive to store commodities, you would have to pay also the storage of these commodities, and that means that in the end, your performance is pretty disastrous. Okay, now investment banks have marketed these commodity funds. They will, at the moment, I'm pretty sure that you have lots of money flowing again into commodity funds because everybody is afraid of inflation and because everybody thinks that commodity prices, there is scarcity. Okay, so I'm pretty sure that there's lots of money flowing into commodity funds, and you can of course get short-term increases in the return. Okay, but the long-term perspective is pretty disastrous. Even that's 2008, 2009 commodity price peak. Okay, yeah, not so impressive compared to the changes in the S&P 500. Okay, so the big sometimes they market this as an investment in something that is sure to go up because you invest in commodity. You have something tangible. You know what you're buying and so on. And not so much. I mean, you have seen that you don't buy the commodity, you buy a future. Okay, and that's not so tangible, and actually you're losing a lot of money on all kinds of on the roll yield and so on. Okay, so that's pretty clear. So instead of marketing it as something that produces a high return, they will sometimes market this as something that enables you to diversify your portfolio. Okay, and they would argue that the long-term correlation between commodities and, for example, the S&P 500 stock market index is negative. Okay, so that's from a presentation by Goldman Sachs, where actually they indeed generate, okay, or show that you have a negative correlation, okay, between the Goldman Sachs Commodity Index and bonds and the Goldman Sachs Commodity Index and stocks. Okay, so this is a quite encouraging picture. Okay, so for most countries here, you have negative correlations, except if you look at the more long-term picture. Okay, remember this is 87, 2003. Okay, but it turns out that over 87, 2003, okay, the correlation is indeed pretty negative, but you can, so this is the commodity and equity price correlation. Okay, so over in red, let's look at the red one. Okay, you can see that actually in this period, indeed, there was a negative correlation. But if you look at the long-term correlation, okay, it's more often positive than negative, which means that even as a diversification tool, commodities are not sure, okay, it's not necessarily a good diversification tool. So here you have another graph that goes back to 1870s, and that shows you what you would make in a commodity investment compared to other investments. Okay, and again, the S&P 500 is simply a much better investment than anything else. Note that this is a logarithmic scale. Okay, so normally you wouldn't even see these returns if you look at the S&P. So in a nutshell, okay, probably not a good investment. So probably not a good investment, except that you think that we are finally ending up in the hoteling type world, where indeed commodity prices go up with long-term interest rates. If that is true, then you would get a spot return that is equal to the long-term interest rates, and then you would at least have a reasonably well-performing investment. But given that historically and probably in the long run, difficult to say, historically commodity prices have always decreased. The funds that invest in these commodity prices have always also produced pretty bad returns. Okay, and let me just give you a last word. Okay, so same is true for collectibles. Okay, don't be fooled by people that want you to invest in collectible funds. Fine art, wine, cars, watches. Okay, all of these investments. Okay, of course you have some products that have great performance. Okay, Picassos, Rolexes. Okay, but if you go back to the time if you go back to the 1930s, okay, who would have known that Picasso is going to be a big star? There were lots of other painters, okay, that we have now forgotten about. But as somebody who invests in art in the 1930s, it would have been impossible for you to anticipate that this crazy guy, you know, the art of this crazy guy went up in value. Same for watches. Okay, I've done a study with a student where we looked at old watch catalogs. Okay, so you can look at auctions of watches in the early 80s. Okay, and then we just randomly picked, you know, watches from this catalog, and then we checked what are the prices for these watches now. I can tell you that the watches that were very expensive at the time are not the watches that are expensive now. Okay, so you have a negative return from collectibles, and that's not even looking at things such as, you know, storage costs. Okay, so don't buy that stuff for financial investments. If you want a nice watch, buy one. Okay, but don't fool yourself into believing that this is also going to be a good investment. Okay, very likely not. Okay, so let's wrap up here. So we have an additional hour that I'm supposed to, because we lost an hour on the first day. Huh? So what I propose is that we keep that hour for questions once you start really worrying about the final exam. No, so we can either have a Zoom call or something like that, or you can ask me questions by mail. Okay. So I think that's better than, you know, just adding now another hour and covering even more material. So I think we have covered the key input. Okay. So I would suggest that we stop here, and then, I mean, you have the right to ask me questions for another hour per email or per Zoom. Once you have worked your way through the material, and and maybe have more precise questions. I don't know if you have the last year's exams. I should maybe, yes, method of the exam. Yeah, I mean, lots of multiple choice. I think it's going to be an online exam. No, I don't know what we did last time. I would suppose. So it's going to be a lot of multiple choice questions. And of course, some calculations as we did. So all these types of spread bets and so on. So I will give you, future curves, and you can then, yeah. So I'll try to get you the old exams, okay, so that you can train, and then you can ask questions if you have questions on the old exam. So, do you already know when the exam is going to take place? No, you have a date? Yes, I will upload the new files. Yes. But do you have an exam date? I can ask Linda, but no date yet. Okay, so but I think it's going to be quite quickly, no? Because you're graduating, actually, no? I understand that most of you are graduating quite soon, so I think we have to find a date quite rapidly. So I'll try to find the exam from last year. I give it to you. You can look at that. 8th of May. I see. Okay, great. Yeah. So we have a bit of time now. Yeah. Thanks. So yes. So I'll try to find the old exam from and send it to you this today. Okay. And then please come back with questions if there are some things that are not clear. Yeah. Okay. More questions? So I don't know. I mean, I've been told that Didier Marteau, for example, is also talking a lot about commodities in his class. Probably more about derivatives because that's his specialty. But I think last year a lot of the material we covered had already been covered, at least partially, in a different context, maybe, but by Didier Marteau. Apparently not so much this year. I don't know, but given your reactions, I it seems unlikely, or at least you don't remember a lot. Anyhow, okay. So let's stop here. have a nice day, and please don't hesitate to come back with questions. Okay, you have the right to ask questions for another hour, so you should exploit that. Even if you haven't asked a lot of questions throughout the class, maybe you will become more curious once you have seen the exam. Okay, so let's stop here. Bye bye, everybody. Okay, nice talking to you. Even if you haven't talked a lot to me. Okay, so okay, bye bye. Okay. Let's switch it off.